Financial independence has been one of the most sought-after topics for young Indians stuck in that 9-to-5 rat race that just never seems to end. But what if we tell you that you don't have to rely on those 20 or 30,000 rupees per month, and you can make your money that works for you by investing it in the stock market? Here's a realistic way to make more than 100 crores by investing in the stock market. Mohnish Pabrai, Rakesh Jhunjhunwala, Radhakishan Damani, and Azim Premji. These are some investors who broke the shackles of generational poverty by investing in the stock market. And after going through the struggles and investing journeys of these greats, we have deduced a step-by-step procedure that can help you guys to embark on a promising investing journey as well. Now, before we move towards those crucial points, I want you to believe that not everyone's investing journey is going to be the same. And there are going to be some hard points and moments that are going to demand the best out of you. And remember, it is not the end result that should matter the most, but the journey which demands the best out of you. The first step which we're going to discuss is probably the most important one, because it is going to set you up for a bigger goal. Number 1, financial planning and setting of goals. First and foremost, reaching a corpus of 100 crores is not impossible, but it does not come quickly either, and everything's going to start with a plan. If someone's comfortable investing with a systematic investment plan, popularly known as an SIP, at the same time, there are beginner investors who like paying lump sums upfront to go about their investments. To put the long story short, you need to have a game plan. Now, let's just say that you've planned to accumulate 10 crores in the next 20 years for your brother's degree in some foreign country, or for a beautiful house that you want to buy for your family, and for that, you'll need to plan accordingly. For this plan, you need to consider 3 important things. First, are you going to follow a systematic investment plan or a lump sum? Next, what is the monthly sum you're comfortable paying? And last, the most important, what are the return rates you're getting? Let's suppose you're following the traditional SIP method, and the mutual fund you've decided to go with is providing you with a return rate of 13%. And after some budgeting, you've managed to accumulate 40,000 rupees per month. By doing some math, we find out that after 20 years, your corpus is going to surpass 5 crores, and your overall investment will amount to 96 lakh. And once you get the wheel rolling, you know things get heated and interesting. Because what if you get that monthly sum higher and higher? Your desired result of 10 crores can be easily achieved if you plan the monthly sum, and the average returns accordingly. But what if you plan on playing big and reaching a corpus of 100 crores in the next 50 years? Now, let's assume you're investing using the systematic investment plan, and the mutual fund scheme you're going with is giving you an average return rate of 14% at most. And let's assume that you're working at a job where you're making 1 lakh per month. Starting with some financial planning, using the 50 to 30 to 20 rule, you've budgeted your income, and after some deep analysis, you've finally decided to invest 40,000 rupees per month through SIP. You want to acquire a gigantic sum of 100 crores in the next 50 years. Years pass by, and after some long-term consistent investing, your total investments are now amounting to 1 crore and 42 lakhs. And the corpus or the profits you've generated are amounting to almost 23 crores, which is the fruit you get after resilience and patience. Now, after these 30 years, thanks to the company you're working at, over the time you've acquired to pay raise, and now you're earning 3 lakhs per month, which means that now you're comfortable investing almost double the amount you were previously investing. With a monthly investment of 90,000 rupees and a return rate of 40%, over the next 20 years, you'll accumulate more than 50 crores. Which is an amazing achievement. And if you decide to up the ante and increase those monthly investments, you can hit the dream goal of 100 crore rupees. Everything starts with a plan, even if it's a slower one and demands a lot of hard work. Once you get the plan rolling, you can easily accumulate your desired amount by investing in the stock market. Everything needs to be planned, and make sure that you assume all possibilities before sticking to a plan. But the next important point is going to clear out all of your apprehensions regarding those popular debates surrounding the Indian stock market. And it will eventually help you make better investing decisions. Number 2, SIP or lump sum. Now, if you're already into investing or financial freedom, you'll probably know that this is one of the most important questions to be addressed. SIP or lump sum. A systematic investment plan is a plan you get personalized for yourself. As discussed in the example before, you can select a fixed amount to be invested per month, along with a return rate you're getting and the number of years you're gonna take for your plan. It is pretty much like the slow and steady approach, while on the other hand, a lump sum, as the name tells, allows you to make hefty payments every now and then along with those monthly payments. SIP allows you to pump some money into your mutual fund scheme monthly, quarterly, or even annually. And on the other side, lump sum investments are often bulky. It completely depends on your living style as to which option you want to go with. For example, if you're working from 9 to 5 and have no side hustle, which could generate some cash flow for you, SIP can be the best option for you because it won't demand a one-time bulky investment from you. While on the other hand, if you're an owner of a promising startup that is generating good capital, for you can opt for a lump sum because it demands a bulky payment. Once you've decided which option you're going with, the next step is perhaps the defining factor in your investing journey. Number 3, consistency is the key. The lure of big money has always thrown investors in the lap of those cruel markets, who, truth be told, don't like befriending investors, especially the new ones. Investing brilliance will not only require research and some nerves, but it also requires patience and discipline. Now, as most of you would have known by now, the market volatility has left many investors confused, and it's a dilemma that many people just fail to put their money to work due to the sole reason of market volatility and risk. So, what is the point? According to the legendary investor Warren Buffett, an intelligent investor should not look at the market closely, and he should always look to make profits in the longer run instead of hopping for quick dashes and surges in the market. There is no sure formula for success in the stock market, but there are some million-dollar rules which, if followed consistently, can help you pull off miracles. And firstly, avoid the herd mentality. If your investment decisions are heavily influenced by things like your best friend's advice, your neighbor's lottery game, or that new mutual friend's attractive banner, then you're part of a herd mentality. As the world's greatest investor Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy. He certainly means it. It's true that the stock market has its ups and downs, and not every day is going to be a sunny day, but as Buffett puts it, patience is the name of the game. But one thing that will help you gain big advantages in the long term is that like and subscribe button. Because as Charlie Munger says, knowledge provides best dividends. And if you do like watching videos related to the Indian investing landscape, make sure you press that bell icon so that you stay updated with the latest news. Take informed decisions. Personal research is of utmost importance when it comes to investing in the stock market. But unfortunately, that is hardly done. As Charlie Munger says, know your investments like you know yourself. Do not invest with emotions. Countless investors have lost their fortunes in the stock market because of their inability to control their emotions, particularly fear and greed. This can create panicking, buying, and selling based on pure speculations, which is devastating. So, do not let emotions cloud your vision. Investing in the stock market is often made complex by those traditional pundits and financial tycoons, and it is made like some complex math problem. But one thing is for sure, if you stick to some golden rules and tips, you're certainly bound to succeed in the Indian investing landscape. So, what do you guys think about the above-mentioned rules to help you accumulate more than 100 crores in the Indian stock market? Will you invest through the traditional systematic investment plan, or are you going to stick with the lump sum? Let us know in the comment section below.